All right, let's talk about investing. We're going to cut through all the noise and get straight to a simple, incredibly powerful way to build wealth, a way that's been proven time and time again. So let's just dive right in.
You know that feeling, right? You decide you want to start investing, and suddenly it feels like you're lost in this giant, complicated maze. There's jargon everywhere, conflicting advice. Everyone's yelling about the next big thing. It's honestly enough to make you just give up before you even start.
And that's exactly what we're tackling today. You're hit from all sides with hot tips and charts that look like rocket science. But here's the secret. What if the most effective, most powerful strategy of all was actually the simplest one? And yeah, maybe even a little boring.
Okay, so what is this amazing yet boring solution? It really just boils down to three super simple ideas: the what, the why, and the how.
First up, the what, and that's something called a market cap ETF. Now, market cap is just a fancy way of saying how much a company is worth. This kind of fund automatically buys you a tiny piece of all the biggest companies. So as giants like Apple and Microsoft get bigger, the fund just naturally owns more of them. You're not trying to pick the next winner, you're just betting on the whole team. Second, the why. This whole approach is called passive investing, and the goal here is key. We are not trying to be some Wall Street genius who outsmarts the market. No way. The goal is way simpler. We just want to get the same return as the overall market for the lowest possible cost. It's the complete opposite of active investing, where people try and usually fail to do better.
And third, we have the how. And honestly, this might be the most important piece of the puzzle. You just continuously buy. You set up an automatic investment for the same amount every single month. It doesn't matter if the market is flying high or crashing and burning. You just keep buying. This simple discipline is the engine that makes the whole thing work. Now, I know what you might be thinking. That sounds way too simple. How could that possibly beat the pros? Well, the data on this is shockingly clear, and it really comes down to one single powerful factor: cost.
So let's put them head to head. On the left, you've got our simple passive ETF. Its goal? Just match the market. It owns a little bit of everything, and the costs are super, super low. On the right, you've got the typical active fund. Its goal is to beat the market. It usually owns fewer stocks, and it charges you a ton in fees for their expert advice. And the difference in those fees? Well, it's just mind-blowing.
Get a load of this. A typical S&P 500 ETF, like one called VOO, charges an annual fee of just 0.03%. It's practically nothing. Now, compare that to the 1 or even 2% that a lot of active funds charge you. That difference might sound small, but over a lifetime, it can add up to hundreds of thousands of dollars that just vanishes from your account.
And here's the brutal result of those fees. This is from the big official S&P SPIVA report. Over a 15-year stretch, more than 90% of the highly paid professional fund managers fail to beat the simple, boring market average. Why? It's those fees. They're like a constant headwind, making it almost impossible for them to win over the long haul.
Okay, that's the theory, but let's see how this actually works in the real, messy world. Let's hop into Time Machine and take a 20-year test drive. Let's imagine an investor who started this simple plan back in 2004 and just never gave up.
And believe me, this was not a smooth ride. Our investor had to live through some of the scariest financial moments in recent history. The 2008 meltdown, the euro crisis, a global pandemic that shut down the world, and then a massive inflation shock. It would have taken some serious guts to stick with the plan.
Let's really zero in on that big one. In 2008, our investor would have logged into their account and seen their portfolio get cut in half, a 50% drop. Can you imagine that feeling? The pure panic? Every instinct in your body would be screaming, "Sell! Get out now!" But they didn't. They just kept buying.
And this brings us to a really weird, totally counterintuitive idea. For someone investing for the long haul, market crashes are actually a good thing. I know, it sounds crazy, but why? Because when stocks are down 50%, your regular monthly investment is suddenly buying you twice as many shares. Crashes are basically a Black Friday sale for your future self.
Okay, so let's run the numbers. Our investor diligently put in $500 every single month for 20 years straight. So the total amount of money they actually invested out of their own pocket was $120,000.
And what did that 120 grand turn into? After 2 decades of just patiently buying, reinvesting dividends, and holding on through all those crazy crises, their portfolio grew to around $430,000. That, right there, is the magic of compounding and simply staying the course.
So we know the strategy works. Now, in our example, we use the S&P 500, but there are other options out there. So let's put a few of the most popular ones through a little stress test, because how an investment holds up when things go bad is just as important as how it does when things are good.
What you're looking at here is the drawdown. That's just the maximum drop from top to bottom during a crash. We've got VT, which is the whole world, VOO, the US S&P 500, and QQQ, which is the tech-heavy NASDAQ 100. Now just look at the dot-com bust back in 2000. VOO fell about 50%, but QQQ lost a gut-wrenching 83% of its value. It took 15 years just to get back to even. The lesson is pretty clear. A more focused fund like QQQ might give you higher returns, but man, it comes with a ton more risk.
And that brings us to the final, and without a doubt, the most important part of this whole thing. The math is simple. The evidence is clear. The single biggest threat to your success isn't the market. It's you. It's your own brain. Look, our brains are hardwired to keep us safe, not to make us rich. So we have these deep primal fears. The fear of buying right at the very top just before a crash. The sheer panic that makes you want to sell when prices are plummeting. And of course, FOMO, the fear of missing out, that little voice that tempts you to chase some risky bet that everyone's talking about. But here's the thing. Logic is the perfect weapon against fear. The market's reality is this. If you're investing for 20 years, what feels like a peak today will probably look like an incredible bargain a decade from now. We already know that crashes are just discount opportunities for people who keep buying. And that next big thing? It's usually just another word for a gamble, not a real investment plan. So let's just boil it all down. Here it is, the entire strategy in 5 dead simple steps. 1. Open a brokerage account. 2. Choose a big, cheap ETF like VOO or VT. 3. Set up those automatic monthly investments. 4. Make sure you turn on dividend reinvestment. And then 5. The hardest step of all, forget about it. Let the system do its work while you go out and live your life.
And that's really all there is to it. The path to wealth doesn't need to be some complex secret. The plan is simple. The proof is there. The only thing left in the equation is you. So, the real question is, are you ready?